Today, we are diving into something that is absolutely fundamental for any trader: market structure. Seriously, think of it like your GPS for the financial markets. Without it, you're just driving blind. You know that feeling, right? You pull up a chart, and all you see is a confusing jumble of lines going up, down, and sideways. It feels completely random, and you end up feeling like you're just guessing. Well, you are definitely not alone in that. That sense of confusion is exactly what traps so many people into bad trades, buying at the very top or panic selling at the absolute bottom. But here's the good news: there is a logical tool to cut through all that noise, and we're going to break it down right now. So here's our roadmap for today. We'll talk about what it's like trading without a map, then define what market structure actually is. We'll cover the 3-day trends you'll see, learn how to decode the details, and then, the best part, see how to take it from theory to an actual trade. Finally, we'll wrap up with why this is your foundational trading tool. Let's get into it. All right, so let's start with the big question. What is market structure? Simply put, it's the bedrock, the absolute foundation of any solid trading strategy. It's really the architecture of the market itself. By learning to read these price movements and patterns, we can get incredible clues about market sentiment. Who's in control here? Is it the buyers or the sellers? And more importantly, where might the price be heading next? Now, to understand that architecture, you've got to be able to see the individual bricks. And in trading, those bricks are called swing points. These are just the obvious peaks and valleys you see on a chart, the swing highs and swing lows. Everything else we're going to talk about is built on these. Okay, so once you can spot those swing points, you can start connecting the dots. And when you do, you'll see one of three market trends emerge. This is where we really start to read the map. First up, the one everyone loves to see, the uptrend. This is when the market is making a clear series of higher peaks, which we call higher highs, and higher valleys, or higher lows. It's a crystal clear signal that the buyers are in charge and that you should probably be looking for opportunities to buy. The easiest way to picture this: just imagine a staircase climbing up. Every single step up creates a new higher high. And the flat part of the step you were just on, that's your high low. Pretty simple when you think of it like that, right? And this brings us to probably the most famous saying in all the trading: the trend is your friend. It's cliche for a reason. When you see a clear uptrend like this, you want to trade with it, not try to fight it. And of course, on the flip side, we have the downtrend. This is the exact opposite. Now we're seeing a series of lower peaks or lower highs and lower valleys, known as lower lows. This is a big red flag that the sellers are in control of the market, which means looking for shorting opportunities is the way to go. So let's go back to our staircase. A downtrend is just like a staircase heading down. Every step down creates a new lower low, and the edge of the step right above it, well, that's your lower high. The third state is the sideways market, which you'll also hear called consolidation or a range. This is what happens when price is just kind of stuck. It's not making new highs and it's not making new lows. It's just bouncing around between two levels, which tells us that the market is basically undecided. Buyers and sellers are in a temporary truce. So we've got our three trends: up, down, and sideways. That's the foundation. But the really important question is how you know when one trend is about to end and another one is about to begin. This is where we need to get into the details and decode the structure. This brings us to two really, really important concepts: the change of character, or chach, and the break of structure, or bos. Now, a change of character, think about as an early warning flare. It's the very first sign that a trend might be about to reverse. But a break of structure is the opposite. It's the confirmation that the current trend is still strong and likely to keep going. Understanding the difference between these two is an absolute game changer. We can also zoom our view in and out. The swim structure is the big picture, the major, obvious trend that you can see right away. Think of it as the main tide. But the internal structure, that refers to all the smaller little price wiggles within one of those big moves. They're like the small waves on top of the tide. And paying attention to the small waves can give you some amazing clues about what a bid tide might do next. Okay, that's a whole lot of theory, I get it, but the real question is, how does any of this actually help you place a trade? So let's get practical and walk through two real world examples to see how it all connects. So let's say you want to trade a reversal. First, you saw a nice clear uptrend, but then you see a sign of weakness. Price tries to make a new high, but it fails. The real confirmation, though, comes when price breaks below that last swing low. Boom, that's your change of character. Often, that sharp move down means an inefficient price area, an imbalance, which some call a fair value gap. That gap can act like a magnet for price, giving you a beautiful place to enter a short trade with your stop loss tucked safely just above that recent high. Now, what about trading with the trend? Here we have a clear downtrend. Price then starts going sideways for a bit, creating a flat area of resistance. Now, watch this. It's very common to see a quick spike above that area. Why? To take out the stop loss order sitting there. But then it immediately reverses back down, continuing the trend and again often leaving one of those price gaps behind. That gap can give you a perfect entry to hop on board the main downtrend. So we've gone all the way from the simple bricks of market structure to some pretty detailed trade setups. Let's just take a step back and really lock in why this is also incredibly important. Look, the most important takeaway is this: market structure is not just some abstract theory you read in the book, it is your GPS. It gives you context and direction for every single trade you even think about taking. It tells you whether you should be looking for buys or sells. It tells you if the market is trending hard or just chopping around. It is the map that keeps you from being hopelessly lost. When you understand market structure, a chart stops being a chaotic mess and starts telling you a story. It is, without a doubt, the most powerful tool you can have in your arsenal. So the only question left is, now that you have that, what will you discover?